AIM-listed Caledonia Mining has as its flagship asset the Blanket gold mine in Zimbabwe. It's been a reliable income generator now for several years, and earlier this month it reported that it had produced a record 16,800 ounces of gold in the last quarter of 2019, and it's also increased its dividend as a result. It's also recently completed a deal to increase its ownership from 49% to 64% of the mine. Mark Linworth is Chief Financial Officer. He joins us now. Mark, welcome.
Morning.
Good to have you back in the studio. It comes at a really interesting time with all the news that you've got. What's the message now for shareholders? Because clearly you're on an up in terms of dividend and production, but also mine ownership.
Yeah. So if you look back at last year, 2019, the first half of 2019, we had a lot of internal difficulties relating to grade, and morale at the mine was very badly affected by the monetary situation in Zimbabwe. By mid-year, we got both of those issues sorted out, but then from July into August, we had some big electrical problems as there were massive power outages, and we had to put some steps in to rectify that, which we did mid-August. So basically, August onwards, the mine's been flying. Production's gone back to where we wanted it to be. Quarter four, as you said, was a standout quarter. That means our cash generation improved significantly. The thing we've been working on for the last 5 years is this central shaft, sinking a new shaft from surface to 1.2 kilometres below surface. We finished that in July. We're now busy equipping it, and that will be finished sort of mid to end of perhaps quarter three this year, 2020. That will do a couple of things. It will allow us to increase production. So currently we're running at about 55,000 ounces a year, which we'll make good money on. We'll increase to 75,000 ounces in 2021, 80,000 ounces in 2022, and 80,000 ounces thereon. So extra production, obviously extra revenues. It means our costs come down because we're more efficient, but critically our capex falls off. So currently we've been spending anything between $20 and $22 million a year for the last sort of 4 or 5 years. And we generated that all from cash flows. As we go forwards, that will drop to 10 and then down to 5 million. So we'll be in this fantastic position of having more operating cash as a result of higher sales and lower costs and less capex, and therefore more cash, exponentially more free cash to do stuff with. And there's only 3 things we can do with our cash. We can either increase the dividend, buy back shares, and invest in new growth opportunities. We can consider all 3 of those given the cash that's coming towards us. So the dividend increase that we announced earlier on this month, and we'll pay the dividend at the end of this month, that's just the first step, just alerting the market to the fact that with a relatively modest dividend increase, putting the market on notice that we're entering this period now where we're going to be highly cash generative and we have options as to what we can do with it. So it's a great place to be.
Let's talk about one of those options. That, of course, is being more acquisitive. Now, you've chosen to spend some money in acquiring more a percentage of the mine,
of ourselves,
of the mine itself, to 64%.
Yeah.
Now, that itself actually has been a long time in coming. We knew about this some time ago. What were the mechanics involved in getting this done? Because in Zimbabwe, we constantly hear of the challenges that you have, or certainly had. What happened to delay the actual acquisition?
It was purely bureaucracy. There was quite a knotty tax issue for the vendor, for the party from whom we bought the asset. There was some confusion and complexity relating to the tax treatment of their sale, which took some time to resolve. And then it just came down to just trying to get the bureaucratic system in Zimbabwe to just complete the paperwork. And it's got to be fair. I mean, we operate very effectively in Zimbabwe, but let's be clear, for people who don't have the good fortune to work for Blanket Mine in Zimbabwe, life's difficult. You've got very high inflation, your salaries aren't increasing to match that, you're living in an environment with long power cuts, and it's understandable how civil servants might have other things on their minds rather than actually finishing this piece of paper. I've got to say, none of those issues apply to us. We're able to ring-fence our workers from inflation by increasing their salaries every month, and because they live on the mine, they don't experience outages. So I don't want that. You mustn't read across, but it's a difficult environment to do stuff, and it was purely admin. It took a long time to get it finished, but we're very happy we got there in the end.
Yeah. Briefly on the dividend, what's the yield now on the
yield now is about 3.6%. we're happy as we increase the dividend. I'm a shareholder, and fundamentally, I want a combination of either increased income and or capital growth. I quite like capital growth, but it doesn't matter. I'll take a higher dividend. We'll continue. As we increase the capacity to pay the dividend, we won't give up on increasing the dividend just if the yield just goes up as well. But there will come a point where if the yield gets too high, then we'll reconsider whether we want to increase the dividend and perhaps revert to buying back shares. But we have that flexibility. As I said earlier on, there's three things we can do with the cash: increase the dividend, buy back shares, and look at new investment opportunities. We can do all three of those.
Do you have any preference as the order of those?
I'd like to do all three at once, frankly.
Right.
Because it's a question of balance, really. I mean, if we just paid out every single dollar that we're making, obviously there would be a very significant increase in the dividend, but then we'd be ex-growth, and so you'd expect the market to sort of say, oh, we like the yield, but we don't like the growth. So it's a question of balance, and one of the things we as a management team, we're retaining the flexibility to react and respond to situations as they develop without coming out with some sort of formulaic approach to the dividend will be a percentage of this or a multiple of that. It constrains you too much. I think we've demonstrated over the last 5 years a very strong commitment to paying a dividend when frankly perhaps we didn't need to all the time, and the dividend's a very, very important part of our strategy for rewarding shareholders.
You spoke of the expected increase in your production over the next few years from 59 at the moment to 80,000?
55, 56 up to about 80, yeah.
So, and you also spoke about the benefits in being much larger and your costs go down. One easy way to understand how a gold mining company works is to compare it to the price of gold. We've got gold around about, $15.50 at the moment. Yeah. What is it costing you at the moment to get each ounce of gold out of the ground? What is the all-in cost?
The all-in sustaining cost at the moment is currently in the 800s. I don't know what it was for quarter 4 yet, because we've not got our quarter 4 numbers out. Sure. But given the relatively high fixed cost base, I would expect a very strong all-in sustaining cost performance in quarter 4, because quarter 4 was great production. So historically we've been running at about in the 800s, about $850 an ounce. In the technical study that we put out when we embarked on this central shaft project, we indicated an all-in sustaining cost range of between $700 and $800 an ounce. I'd probably expect it to be the bottom end of that range. So I can easily see, once we get ourselves up to 80,000 ounces a year, looking at an all-in sustaining cost in the low 700s.
Right, and just to confirm, that extra production is going to come through from the new shafts?
It will start coming through from the new shaft beginning of this time next year, beginning of next year. So next year we're looking at 75,000 ounces, and the year after that, steady state, 80,000 ounces.
And for a company like Caledonia, what are the investment potentials out there if you are looking to invest the money back in?
Yeah, we're focused on Zimbabwe. Zimbabwe is a very prospective, geologically highly prospective gold area, and it's been pretty much unexplored for the last 30 years because the environment was just so unconducive. I want to be absolutely clear, we are not thinking about going out and buying a big, hairy, existing operation. There are a few big gold operations in Zimbabwe. We absolutely would not look at those. They're too big. They've got too many issues around them. So we're focused on brownfield projects where we can get our hands on the asset for a couple of $1 million. We can then, over the course of the next 2 years or so, spend $4 or $5 million to prove up a meaningful resource base, and then take it from there. So we think that's a much more sensible way of using shareholders' funds. Are
you just interested in gold, or is there an opportunity?
Yeah, gold's what we do.
Because Zimbabwe is full of
all sorts of stuff.
Valuable resources.
Sorts of stuff. Typically, it doesn't have scale, but gold is what we understand, and it's it sells itself. We don't have to go around selling it. It's not, if you're getting ferrochrome, you've got to get involved in sort of difficult marketing or other stuff. So gold is pretty much where is where we're focused. We wouldn't look at anything else.
Yeah, in terms of the gold price, I know you're not a gold analyst as such. You do obviously like to see a higher gold price. What are you working on as the man that controls the numbers in terms of where gold is going?
Okay, we've hedged at 1,400 for the first 6 months of this year, and we've hedged because we still have a very substantial capex obligation until the end of July. And if gold fell much below 1,400, that will put our cash flows under some strain. So we've hedged at 1,400. But going forwards, as we increase our run rate, as we've outlined, to 75 and 80,000 ounces, we can easily accommodate a gold price of well below $1,000 an ounce. Now, that's not to say that's where we expect it to go, but we're a very defensive stock when it comes to being a gold producer. We're not a high-cost marginal stock.
Before we leave you, just a quick reference, if we can, on the share price. Here we have the share price going back to the highs that we had back in May 2018 of £7. 6.52 is where we are at the moment. What are you working on in terms of share price? I mean, do you have a view on share price, or you just leave that up to the market and just say, well, you're going to carry on doing what you're doing? What's being priced in, I suppose, is the question at these levels.
We don't control the share price. No. I wish we could. Obviously, we're going to say we think we're undervalued. Everybody thinks their shares are undervalued. We think as the market recognises the proximity, how close we are now to delivering this cash, and that will be made very clear in terms of not just quarterly reporting and see the cash on the balance sheet, but actually hopefully increasing the dividend. We hope that over time, as we move forward on a quarter-by-quarter basis, the market will begin to realise that actually this is happening, it's real. And that's one of the reasons why we have adopted an approach of looking at relatively modest quarterly dividend increases, not a big one-off increase, to give people time to warm up to the story and get comfortable that this actually is a real thing and it's really happening.
Yeah, okay, it was a pleasure to have you pass by. Thanks indeed.
Thank you.
For your time. Mark, that's Mark Learmonth from Caledonia Mining.